Folks, Scott here, and this is the wrap for Tuesday, August 6th. So today I had an unfilled down gap. You see the white line represents yesterday's close, Monday's close, and we did not fill it today. The high was below yesterday's closing price, and we tested the 10-day moving average. As I noted in last night's video, the prior 2 days have both put in the same high, which was at least a 20-day high. It's actually a 200 multi-year high, all-time high, right? So let me show you the results of fading gaps following at least a 20-day high in one of the 2 prior days and following an unfilled down gap. Or said differently, following an unfilled down gap after a 20-day high in one of the 2 prior days. And also above the 200-day moving average. Whoops. Get to my back testing page. And there you go. It's 50-50 in terms of which way we're likely to gap after such a scenario. So that's a decent sample size and implies it could go either way tomorrow at the open. Using an end of the day stop, it's had a higher win rate to the downside. 80% of these using an end of the day stop have filled by the end of the day. Pretty typical anytime you're following an unfilled gap. Markets moved a fair amount or far enough in an extreme enough manner that it wasn't even able to fill its prior day gap. Often pauses and consolidates before making up its mind which way it's going to go from there. So nothing surprising there. The average loser is great, hasn't made much money, but that's really influenced by this one monster loser. And that was actually 2 trades ago. Let me see, that was right there, April 15th in this scenario. It was a big loser for going long. So if you get rid of that, I would never lose that much because I'd have an intraday stop. And so a down gap looks to be okay. An up gap looks to be okay too. One thing that catches my attention is that it is lower than the 70% average historical win rate. So it may be weaker. And in fact, we ran this in the trading with our MTG stops just now, and I'm going to show that to you super quickly because I want you to use a little extra caution. If we do happen to gap up tomorrow, don't assume it's just naturally a good trade. I'm not going to always be able to show you or point out when intraday volatility may be higher than normal, but I did note this and I wanted to share it with you. So what I just did was I changed it to our MTG stop parameters. Watch what happens to these numbers. It looked to be an okay gap setup for shorting up gaps using an end of day stop. But as you're about to see, it is not. 50-50 break-even strategy historically using intraday stops. So the way to interpret that in my mind doesn't mean don't touch anything short tomorrow. What it tells you though, especially with that end of the day stop number being decent, is that you either delay your entry, like use a 15-minute range like we do here at Match the Gap, or some other technique for delaying your entry and going for gap fade. Or maybe use a bigger stop. I would just delay my entry with numbers like that. Now I'm way ahead of myself. I'll defer to our gap guides and my worksheet before I make my final decision, but I thought I'd share this nugget with you going into tomorrow. In a down gap, you can see he actually hasn't made much money either because the average size win is so small compared to the average size loss. So may not be a strong edge there either. All right. Let's look at what the worksheet showed going into today. That's a summation or the summary of all of our 8 individual indices gap guides. That's where I start my analysis. And for today, it was just neutral to slightly attractive setup for buying down gaps, but below the low was actually weak. So that gives you a little bit of caution since these markets opened right at yesterday's lows. Looking at the 8 individual gap guides, they were neutral overall to me. The way the markets were set up per our gap guides was just 50-50. In terms of unique patterns, we had a couple risk factors here, or at least one. After a false up day, that's a green candlestick, but with a lower close during a bullish market, is normally problematic for down gaps because it means you've sucked in some longs, and they're going to be forced to puke up those trades the next day if you have weakness, or many of them will. And let's see my pre-market comments. Nothing but other risk factors. Per last night's video, down gaps after a 20-day high and an inside day. Went above a 250-50 trade, big money loser. Right, profit factor of 1 is break even. 0.5 means it's lost twice as much as it has made. See, fading gaps in August, good information for the rest of the month. As long as we're above the 10 and 200-day moving averages, down gaps, dogs, 50-50 trades. So neutral guides, mostly negative factors for down gaps, it doesn't get much easier than this to leave it alone. So certainly riskier than yesterday, and that's what I said down here. I left it alone, and that ended up being a great decision, as you probably realize. See, the indices, Russell did not fill. Hard to tell if the NASDAQ filled. It came close. Dow never came close. The blue line is prior close. You can see the price action for the day. The white line is where we actually opened right on yesterday's lows at 1698.75, so you can't even see a white line here because we opened on yesterday's lows. That defaults to the riskier UL zone, which is below the low of an up day, and that means it's a blood gap. If you've listened to any of my prior presentations over the past many years, don't touch the bloods. Below the low of an up day is a really risky trade and money loser historically. So I left it alone and had a short bias because we opened right at those lows. 15-minute range guides came out. Oh, by the way, I avoided a losing gap fade, by the way, and many of our members did too. And let's see, this 15-minute range guides, low breakout favorite. I'm looking for 55 and 1.1 weighted average of our three systems for the low breakout. Check. Right at it, check. Right at it, check. And low fade favorite, so no check there with the Russell. Looking at the ETFs, more of the same. Check, check. Low fade favorite in the Qs, neutral in the Russell. So not overly compelling, but 5 of the 8 indices met my criteria, and it was a blood gap with several factors favoring the downside. No brainer, go short. Even though the advanced studies showed some risk for going short on low breakouts this time of the month, these other technical patterns were too big to ignore, so I went short 1697.75 and made an easy, pain-free +4, as did many of our members in the ES only. First hour range guide came out, and it actually triggered before I made up my mind, and it just had gone too far. Basically went on that first bar 3 points of the 4 points. Did hit the target. It also favored the low breakout, but I missed it. Decided to do a delayed entry or discretionary trade, thinking we may test the lows later this afternoon. Went short over here and got out for basically a scratch trade at the end of the day. Also did the gap gotcha at the end of the day and got out for -3 ticks on that. So just a couple of nominal trades there. Made some money in the 50-minute range breakout. Missed the first hour. A little disappointed. But I avoided a losing gap trade. So all in all, made money. Avoided a loser. Good day. And there you go. That was my day. That is the wrap for Tuesday, August 6th.